Hello and welcome to this episode of The Third Empire. In today's episode, we try to understand the announcements stemming out of the recently concluded Monetary Policy Committee meeting and understand its impact as the RBI remains focused on taming inflation. We also look at the impact that the rising interest rates and financing costs are having on the corporate earnings as the margins reported in the Q3 results look dented on the back of higher interest outflows. Lastly, we talk about how India is taking the center stage in the global oil supply as it turns Russian crude into West's fuel. You watching Informed Investor, The Third Empire, an initiative by Research and Ranking. Let's begin. Now, even before I dive deeper into what exactly stemmed out in this Monetary Policy Committee meeting, let's first understand what exactly is the Monetary Policy Committee. Now, the Monetary Policy Committee is a committee constituted by the central bank and it is led by the Governor of the Reserve Bank of India. It was formed with the mission of fixing the benchmark policy interest rates, that is the repo rate, to restrain inflation within the particular target levels. Now, the Reserve Bank of India's governor controls the Monetary Policy Committee's decisions with the support and advice of the internal team and the Technical Advisory Committee. Now, to constitute the MPC, the Reserve Bank of India Act of 1934 was amended by the Finance Act in 2016 in order to bring more transparency and accountability in fixing India's monetary policy. Initially, the main decisions related to interest rates were taken by the Governor of the RBI alone before the establishment of the Monetary Policy Committee. Now, the committee comprises of 6 members, 3 officials of the Reserve Bank of India and 3 external members nominated by the Government of India. The first will be the Governor of the Reserve Bank of India, Shri Shaktikanta Das ji. The second would be the Deputy Governor of the Reserve Bank of India, which is currently Dr. Michael Debabrata Patra. The third is the Officer of the Reserve Bank of India, currently Dr. Rajiv Ranjan. Fourth is Professor Ashima Goyal. She is a professor at the Indira Gandhi Institute of Development and Research and she is the member of the Monetary Policy Committee. Fifth is Professor Jayant R. Verma, who is a professor at IIM Ahmedabad. Sixth is Dr. Shashanka Bhide, who is a Senior Advisor, National Council of Applied Economic and Research. Now, the Governor of the Reserve Bank of India is the chairperson of the committee. The decisions are taken by the majority, with the Governor having the casting vote in case of a tie. The current mandate of the committee is to maintain 4% annual inflation levels until 31st March 2026, with an upper tolerance of 6% and a lower tolerance of 2%. So why exactly is the Monetary Policy Committee meeting important? Now, the Monetary Policy Committee meeting is important because it is responsible for setting the monetary policy of a country, which includes decisions on the interest rates and other monetary tools. Now, the Monetary Policy Committee's decisions have a significant impact on the economy, affecting inflation, growth, and exchange rates as well. Now, by adjusting interest rates, the MPC can influence customers and business spendings and help to control inflation. The outcomes of the MPC meetings are keenly watched by market participants as they provide insights into the central bank's views on the economy and its future directions. So what are the key highlights of the latest MPC meeting? The RBI's Monetary Policy Committee believes that the more calibrated monetary policy action is required to stabilize inflation expectations, to break the persistence of core inflation, and to boost medium-term growth prospects. Accordingly, the Monetary Policy Committee decided to increase the policy repo rate by 25 basis points to 6.5%. Now, the MPC decided to remain focused on the withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Now, the RBI has increased the repo rate by a cumulative 250 basis points or 2.5% to 6.5% since May this year. While the rate hike was largely on expected lines, many agencies expected the stance to change to neutral. However, the central bank said that the RBI's policy stance remains focused on withdrawal of accommodation. Now, having said that, the RBI projected the GDP growth for FY24 at 6.4%. The MPC has slashed the GDP forecast for FY23, which is the current fiscal, to 6.8% in the December policy review from an estimate of 7% earlier, as risks continue to emanate from prolonged geopolitical tensions, a possible global slowdown, and the tightening of the global financial conditions. Now, it also highlighted the fact that India's economic growth was resilient and that high-frequency indicators had suggested that economic activities remained strong during the third and the fourth quarter of the current fiscal. Now, further data on urban consumption suggested that demand has been firming up and was led by a sustained recovery in the discretionary spending space, especially on services such as travel, tourism, and hospitality. Now, the RBI has lowered the inflation target for the current fiscal from 6.7 to 6.5%, which is still above the RBI's comfort level of 4% with a 2% of upper and lower standard deviation. Now, the inflation expected to be at 5.3% in the next fiscal year. Inflation for the fourth quarter of FY23 is forecasted at 5.7% as against the earlier forecast of 5.9%. The MPC highlighted that while the headline inflation has been softening, led by the deflation in vegetable prices, headline inflationary pressures excluding vegetables has been rising above the tolerance levels and might remain elevated, especially with the pressure from core inflation. Core inflation, as we know, is the change in price of goods and services, and it doesn't include the price change in the volatile food and the energy sector. Now, the external sector has been affected by strong global headwinds. Slowing global demand has been weighing on our merchandise exports. The growth of merchandise imports is also losing steam. At the same time, the impact in terms of a trade shock due to the Russia-Ukraine war is gradually normalizing. At times like these, it is important to take cognizance of India's innate buffers. The growth of service exports, mainly contributed by software, business and travel services, remained robust at 24.9% in the third quarter of the current fiscal when compared to the year-ago numbers. Now, the remittances also scaled new heights, with the outlook remaining optimistic on the back of a pickup in activity in the Middle East. Now, in the first half of the current fiscal, remittances to India rose by 26% year-on-year, which is more than twice the World Bank's projection for the current year. Now, the net balance under services exports and remittances therefore remained in large surplus, partly offsetting the trade deficit. The current account deficit, which by the way is the deficit arising when the value of goods and services we import exceeds the value of those we export. So the current account deficit has witnessed signs of improvement and has stood at 3.3% of the GDP during the first half of the current fiscal. This was led by the moderation of imports due to lower commodity prices. Consecutively, even if the current account deficit is higher than that we had seen in the previous fiscal year, it is eminently manageable and within the parameters of viability. So what are the key takeaways from the latest MPC meeting? Now, taming inflation and ensuring macroeconomic stability continues to remain the key priority for the Reserve Bank of India. The general focus is that the inflation has peaked. However, the core inflation still remains sticky. The 25 basis points increase in the repo rate is in line with the expectations, and there was no surprise element here. The hike was known to the market and it did not have any meaningful impact on the equity markets either. The RBI may look to pause the rate hike and the rate could remain unchanged in the next meeting as inflation continues to trend downwards and there are no further global disruptions. However, the MPC remains watchful of the economic indicators. The Reserve Bank of India will continue to ensure price and financial stability while supporting growth. Now that we've looked at the impact of the MPC's rate hikes, we look at how it has impacted India Inc.'s corporate earnings. After supporting India Inc.'s profit for 2.5 years since the outbreak of COVID-19 at the end of the fourth quarter of the financial year FY20, interest rates and financing costs have become a drag on the corporate earnings. The increase in such costs comes on the back of interest rate hikes by central banks around the world in an attempt to cool inflation, which shot up in 2022 because of supply disruptions caused by the pandemic and Russia's invasion of Ukraine. Now, interest rate hikes by a central bank can have a profound impact on companies. The magnitude of the impact depends on several factors, including the specific circumstances of each company and the overall state of the economy. Here is a more detailed explanation of the impact of the interest rate hikes on companies. First, it leads to increased borrowing costs. Companies that have taken out loans or bonds will see their interest expenses rise as the cost of borrowing increases. This can reduce their profitability and competitiveness. For example, if a company has taken out a 10-year loan and the central bank raises interest rates, the company will be forced to pay a higher interest rate on its debt, which will increase its debt service costs. This can reduce the company's ability to reinvest in its operations or pay dividends to its shareholders. Second is the reduced consumer spending. Higher interest rates can also slow down consumer spending as individuals have less disposable income to spend on goods and services. This can negatively impact companies that rely on consumer demand for their products. For example, a company that sells cars may see a decrease in the sales as consumers opt to save their money or spend it on necessities rather than buying a new car. Third is the reduced investments. Companies may also decide to reduce their investments in new projects or expansion if the interest rates rise. As the cost of borrowing becomes more expensive, this can reduce economic growth and job creation. For example, if a company was planning to build a new factory, but the interest rate hike makes borrowing more expensive, the company may decide to delay or even cancel the project, which would reduce job creation within the local economy. Now, according to a business standard sample, the combined interest expense of 888 listed businesses, excluding firms in the banking and financial services space, rose by 30.8% year-on-year in the third quarter ending December 2022, which was the fastest pace of growth in at least the last 17 quarters. Now, in comparison, these companies' combined operating profits, which is the EBITDA, that's the earnings before interest, tax, depreciation and amortization, declined 2.2% year-on-year, and the net sales rose by 18.2% year-on-year in the third quarter of this fiscal. This was the first time in the last 9 quarters when interest expenses grew faster than both the top line, which is the net sales, and the operating profit. Now, as a result, the combined net profit of these 888 companies declined by 12.7% year-on-year to 1.21 trillion rupees from 1.39 trillion a year ago. Now, India's companies' margins were dented in the December quarter due to elevated financing expenses as companies borrowed more working capital at higher interest rates. Now, analysts attribute the faster growth in companies' interest expense and a decline in their interest coverage ratio to both a rise in interest rates in the last 1 year and incremental borrowings by many companies. Now, on the bright side, the Q3 results indicate a sequential decline in the input costs as well, which cushion the impact of higher interest expenses. Now, the commodities market went for a wild ride last year. After the unprecedented attack by Russia on Ukraine, the oil prices suddenly became extremely volatile. In response to this unprovoked and unjustified invasion of Ukraine, many nations imposed import or transfer of seaborne crude oil and petroleum products from Russia. Now, the sanctions were implemented on Russia by predominantly the G7 countries and a few other countries like Canada, France, Germany, Italy, Japan, the United Kingdom, United States, Australia, and all of the European Union countries. The G7 implemented a $60 price cap on Russian oil. The European Union and the G7 allies also urged India and China to support them to at least put a price cap on the Russian oil. But India had other plans, as this had opened a new path for India. India started importing oil from Russia, and the imports have crossed the 1 million barrel per day mark in December. In January, it crossed 1.3 million barrels a day mark as well. Now, at the same time, China was seen as the second largest buyer of the Russian oil in January. China and India have been a lifeline for Russian crude exports given their large refining capabilities. This also means that they will continue to buy cheap imported crude oil and process it domestically rather than buying refined oil. Let's discuss this above statement further. India is playing an increasingly important role in global oil markets, buying more and more cheap Russian oil and refining it into fuel for Europe and the US. Though US officials are aware that Indian and Chinese refiners can earn bigger margins by buying discounted Russian crude and exporting products at market prices, they are fine with it. India shipped about 89,000 barrels a day of petrol and diesel to New York last month, the most in nearly 4 years according to data intelligence firm Kepler. Daily low sulfur diesel flows to Europe were at 172,000 barrels in January and the most since October 2021. Now, India has been taking great advantage of the discount provided by the Russian suppliers. India has saved thousands of crores of rupees buying discounted Russian oil and also saved on the outflow of dollars at a time when the local currency has been weak. India has made it clear that it would prioritize its energy needs and continue to buy oil from Russia. According to industry estimates, India is estimated to have saved over 35,000 crore rupees by importing cheap Russian crude since February 2022. Now, the group of 7 nations or the G7 are keen to cut Moscow's revenue as much as possible, but they also have an interest in ensuring that Russia's oil and refined products continue to flow to avoid a global supply crunch. India's crude oil imports have grown multifold on a year-on-year basis, reaching more than 33 times. Russia has now become the single biggest oil supplier to India, having overtaken Iraq and Saudi Arabia. Under the European Union guidelines, India is operating within the rules. When Russian crude is processed into fuel in a country outside of the bloc such as India, the refined product can be delivered into the European Union because they are not deemed to be of Russian origin. And India hasn't faced any backlash as such, as it is meeting the West's twin goals of reducing Russia's energy revenue while also preventing an oil supply shock. With Europe and the US ramping up their sanctions, India is only going to become more central to a global oil map, as it will continue to buy crude oil from anywhere in the world, including Russia, to meet its energy needs. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.